Hi everyone, welcome to this 10 minutes concepts video. My name is Jatin Agarwal. I'm a chartered accountant by qualification, and today in this 10-minute concepts video, I'll be talking about the revaluation method of accounting laid down in IAS 16 property, plant and equipment. Before we jump onto the topic, a brief introduction about myself. I'm a chartered accountant by qualification, now having a post-qualification experience of approximately 11 years in accounting and financial reporting matters. Without wasting much time, let's first understand what is this revaluation method. So if you, as you're all aware, IAS 16 is a standard which deals with property, plant and equipment, accounting for property, plant and equipment, right? So broadly, if I talk about the standard, we can categorize this standard into 5 subtopics. First topic would be talking about the definition, what exactly property, plant and equipment is, etc. Second, we need to understand in this standard is the recognition principle. When do you actually recognize a property, plant and equipment in the balance sheet? That's it lays down the guidance around this area. And then we need to talk about, then the standard actually talks about initial measurement, and finally talks about subsequent measurement. And it also talks about the derecognition criteria. It's also talk about the principles for presentation and disclosures, right? So as far as recognition is concerned, as we all know, there is the two conditions that needs to be satisfied. I'd commonly remember this as PC, which is not personal computer, but probable that a future economic benefits will flow to an enterprise, and also the cost of that particular assets can be measured reliably. These two conditions are satisfied, my asset can be recognized in my balance sheet, right? And on day one, at what value are we supposed to recognize this asset? Mandatorily, it has to be at cost only, right? Now the entire accounting policy choice is in the case of subsequent measurement. What is subsequent measurement? That is on day one, when you've recorded a particular asset at cost, at a reporting period, let's say at year end or at interim period end, at what value are you supposed to record this particular asset at? There we have two policy choices. First is called as a cost model, and second we have a revaluation model. Okay, let's try and understand this with the help of an example. Let's say you have purchased a particular asset that is worth $1,000. Now initial measurement, or under both the accounting policies, be it cost model or a revaluation model, would be at cost itself, right? So my initial measurement will be at 1,000 only. I'll capitalize this particular asset as 1,000 on day one. At the end of year one, let's say, which is my reporting period at the end of year one, my depreciated value I've assumed is 700. Okay. In the revaluation model, I've also depreciated this asset and the value now is 700. Now, let's say at the end of year one, the fair value of this asset, which is currently recorded at the value of 700, the fair value of this asset is actually, let's say, 500. Or there can be another situation where the fair value of this asset has actually increased. Let's say it's assuming, let's say the asset that we are talking about is a land, and the value of that land has increased to 1,200 rupees. Right? So how should we deal with this in this kind of a situation in the cost model, and what is going to be the impact if we were following the revaluation model? If I'm currently not confusing this, I'm trying to keep this simple and not confusing this with the impairment. Let's say that the value in use of a particular asset is more than 700, and that is why the recoverable amount of this particular asset is more than 700, and there is no impairment charge to it, right? But currently we are only focusing on the fair value. So if the fair value of this asset has reduced to 500, or this fair value of this particular asset has increased to 1,200, then there is not going to be any change in the accounting, right? Assuming there is no impairment trigger, my accounting will not change. So what is actually happening? Even if there is an increase in the fair value, I'm not able to capture the increase in my books of accounts. If there is a reduction in the value, I'm not able to capture that reduction in my books of account. What my asset is actually being presented is at the historical cost, and which is depreciated over the period of time. And if there is any impairment, it was going to be impacted by that. On the contrary, if we are following revaluation model, right? In the revaluation model, if my value of this particular asset, the fair value of this particular asset is reduced to 500 or it is increased to 1200, I would restate, or I would say I will remeasure my assets to 500 or 1200. So let's just understand how this accounting will actually work. Let's say in year one, when you do this revaluation exercise, you see that the assets value has gone up by $20. How do you account for it, right? So any increase in the value, that is a revaluation surplus. In case of a revaluation surplus, you account for that surplus through an OCI, through other comprehensive income. What is going to be my accounting entry? My PP account gets debited by 20 to revaluation surplus OCI account credited. So basically, there is a separate reserve that gets created in a statement of changes in equity by the name of revaluation surplus, and your entire increase in the value of net assets would be parked in this particular SOCI, statement of changes in equity. Right. Let's say in year two, assuming that the fair value of that particular asset has reduced, and this time it is reduced by 25. Assuming currently, to give you the concept, I'm assuming that there is no depreciation or everything. In the year one, it increased by 20. In the year two, it reduced by 25. How do you account for it? Right. You remember that in OCI we created a reserve for rupees 20. Right. So how do you account for this 25? For accounting this 25 rupees of loss, first you will utilize the loss which is there. First you will utilize the surplus which is available in the SOCI. So first you reduce your OCI balance of 20, and whatever is the balancing figure, the second step would be to park this extra loss into your P&L. So what is going to be your accounting entry? Accounting entry would be revaluation surplus OCI account debited, revaluation loss, which is going to be charged in the P&L account debited, which is going to be 5 to PPE. Right. This is how your accounting entries would flow. Again, let's take one more example. In year one, let's say we are having a loss. How do you account for it? Now, in this case, you don't have an OCI reserve on day one. On the day one itself, at the end of year one itself, you have a loss. In that scenario, you'll first park the loss into P&L, which is going to be minus 20, and your accounting entry will be revaluation loss P&L account debited to PPE, right? And year two, if I assume that there is a gain of 25, that is vice versa of what we discussed in our previous slide, we'll first utilize the loss which has been parked in P&L. So we'll say to the extent of loss which was earlier recognized in P&L, we'll recognize a gain in the P&L, which is of 20, and whatever is the differential, that we will park into OCI. Okay, so I generally remember is that this is the benchmark, this is the cost that was there. Any increase in the value would be parked into your OCI. Any reduction in the value will first utilize the OCI reserve and then go into my P&L. Any increase further, if there is an increase thereafter, then first I will utilize the balance which is there in the P&L, and once I reach my historical cost, and any gain therefrom will be parked in my OCI. Right, that is how I generally remember this transaction. That's it for this short video. I hope you liked it. In case of any suggestions or any queries, please feel free to write down in the comment box. Thank you so much and have a nice day.